Guys, if you're a South African and you haven't quite planned for retirement yet, please take a look at this. So this is information taken directly out of the Millpark study guide, and I'm going to be showing you the exact difference between a living annuity and a retirement annuity. Now, this is going to be a complete roadmap for you guys, and the reason why it's important is because most South Africans don't understand the difference until they hit retirement, and by then they're already going to be making costly mistakes. Okay? So a basic difference between a retirement annuity and a living annuity is a retirement annuity is a savings vehicle before retirement. So it's a savings method of retirement before you get there, where a living annuity is an income vehicle after retirement. So essentially it's more like retirement annuity is the accumulation phase of funds when you get to retirement. Living annuity is the decumulation phase of funds after retirement. Okay, so fairly straightforward, fairly simple, and I'm going to break it down step by step. So first thing is retirement annuity. A retirement annuity is a savings product and falls under what we call the Pension Funds Act as South African legislation. It's designed to encourage long-term savings through tax benefits, and contributions are invested into things like unit trusts, portfolios, or funds managed by investment firms. Okay, contributions can be tax deductible of up to 27.5% of the taxable income, capped at 350,000 Rand per year. Any excess contributions will then carry forward into future years. Also, your employer can contribute on your behalf and it counts towards the same limit. So, for example, if you earn 500,000 Rand per year, your max deduction is going to be 137,500. If you contribute to 150,000, the extra 12,500 Rand will then carry forward into the new year. Okay, so tax deductible. Investment rules under the Regulation 28 in the South African legislation, Regulation 28, it's designed to reduce risk. So the max exposure that any retirement annuity can have right now is 75% equity, 25% property, 45% offshore, and 10% hedge funds. So essentially, this protects investors, but it limits aggressive growth and it limits people who want 100% offshore strategy. Okay, so you can only have 75% equity in your portfolio, and of that 75% equity, only 45% can be offshore funds. Okay, so it's designed just basically to reduce risk and stop guys chucking their full retirement annuity into a equity offshore strategy, okay, which is obviously higher risk. So Regulation 28 is designed to reduce risk. In terms of access and withdrawals, when it comes to liquidity, your funds are locked up until the age of 55. Exemptions would be if you have permanent disability or early retirement, then you can fall under the fund rules. However, at retirement, only 1/3 is going to be available as a lump sum. Okay, so if you get 3 million Rand at retirement, only 1 million Rand will be available as a lump sum payment to you. And then the first 500K would be tax free across your lifetime, which is quite interesting. The other 2/3 that you get, you have to buy a annuity, for example, a living annuity and a guaranteed annuity. And we're going to go through what exactly these are now. Okay, so the first 1/3 of your retirement you can take out as a lump sum. The other 2/3 you have to buy a living annuity or a guaranteed annuity. In terms of tax treatments, contributions, obviously the immediate tax savings is what we spoke about. Any growth inside is completely tax free. So you don't have any capital gains tax. There's no dividend tax. There's no income tax, which is quite good. And then obviously lump sum withdrawals are taxed on retirement lump sum tax table, which you can find in another video. Then ongoing annuity income is obviously taxed as pay as you earn. Okay. Now, some of the cons and pros with regards to a retirement annuity: lack of liquidity. Of course, you can only withdraw it, when you're at 55 years old. Limited offshore diversification, as spoken in Regulation 28. And then obviously at retirement, you're forced to buy an annuity. Okay. Pros, obviously, the powerful tax benefits we spoke about. Compulsory discipline is obviously you can't access funds before, whether you want to or you feel like you need to. You can only access it at 55, which is obviously, it can be seen as a benefit. And then, of course, tax-free growth compounds faster, enabling smoother retirement. So retirement annuity, that's exactly what it is. And then we're going to go into what exactly is a living annuity. Now, a living annuity is an income product purchased at retirement with accumulated retirement savings. So if you had a retirement annuity, you can then take 1/3 as a lump sum, should you wish to. The other 2/3, you can buy an annuity, either guaranteed annuity or a living annuity. A guaranteed annuity, essentially, you give your full lump sum to a provider, and the provider guarantees you payments every single month till the day you die, which is quite cool. But at the same time, you never get to see that full lump sum of money that you made for retirement. Okay. But in terms of a living annuity now, it's an income product purchased at retirement with accumulated retirement savings, as we spoke about. It provides flexible retirement income, unlike the guaranteed annuity, which we also just spoke about. So in terms of how to fund a living annuity, you have to fund it with pension fund proceeds. You have to fund it with provident fund proceeds or retirement annuity proceeds. No new contributions are allowed and can only be transferred from retirement funds. Okay. Income rules: you must draw between 2.5% and 17.5% of the capital per year. Now, bear in mind, if you're continuously drawing 17.5%, you're going to lead to a shortfall. So it is obviously capped, but you have to draw between 2.5% and 17.5%. Income can be adjusted annually depending on your anniversary date. So you can either be paid monthly, quarterly, annually. So as you can see with this living annuity, there's obviously a little bit more flexibility here, which we'll get into right now. So investment flexibility, you choose the underlying funds in terms of equity. If you want it to be in a balanced market or a money market, greater control than a guaranteed annuity. And then obviously the risk of it is that if the market performs poorly and the drawdown's too high and you're withdrawing a lot of your money per year, then of course it's going to lead to your money running out. Okay, so yes, there is investment flexibility. Yes, you can choose the market you want to invest in. Yes, you can yield optimal or higher returns, but you do face the risk of your fund performing poorly. But now I'm going to show you exactly why people still choose this. Okay, so in terms of tax treatment, growth is obviously tax-free still. Withdrawals, tax is pay as you earn still. And you can deduct things like medical credits and rebates, which can reduce your payable tax bill. But now the benefits of this is obviously now estate planning, as opposed to a guaranteed annuity where you have money paid to you every single month, but you never get to see that lump sum. If you die, that money is gone. Whereas at least you can set up estate planning benefits with this living annuity. So any remaining balance that passes directly to your nominated beneficiaries if you die. So if you die, if you have 3 million in retirement or 10 million in retirement and you only use 5 million, that last 5 million can then be transferred to a beneficiary or a few beneficiaries. You avoid estate duty and executor fees and delays, which is quite cool. And then obviously income continues for the dependents. So very, very important to understand, because now the pros and cons are: pros, you have flexible drawdown, you have investment choice that you can choose from. The remaining balance is inheritable and can be passed down to heirs, and you have control over your investments. Okay, you got potential to grow your investments further during retirement. But now, obviously, the cons are your investment assets can investment risk rests with the retiree. So when you retire, you are responsible for this funds. Obviously, now you can use financial planners and investment planners and advisors, but that responsibility to make that last final choice is up to you still. You can also have poor drawdown choices and can exhaust funds. And then, of course, requires active management and advice as we just spoke about. So as you guys can see, when you come into retirement with your retirement annuity, you obviously get good tax contributions and deductions. Obviously, now you're limited based on the regulation 28. In terms of access and withdrawals, you can only withdraw it until you're the age of 55. But at the same time, you have to use one third of it. You can only use one third of it to withdraw as a lump sum. The other two thirds, you have to buy an annuity. In terms of the annuity now, you can choose. Do you want to buy a guaranteed annuity? Do you want to buy a living annuity? And with a living annuity, you obviously get access to then your investment choices. For example, if you want to have it in a money market, equity, balanced, whatever the case might be. But bear in mind, you can run out of money and you can face drawdown. Whereas with a guaranteed annuity, you obviously get payments every single month till the day you die. But with a guaranteed annuity, if you die and you still have money left over, you've got no beneficiaries to leave your money behind to. So, guys, very, very important to take into consideration. Please visit a qualified financial advisor before making any decisions based upon this. But if you've got an idea, the difference between retirement annuities, living annuities, guaranteed annuities, you're going to have a lot of more confidence coming into retirement. Cool, guys. If you need any help, send me a DM. I'll see you on the next video.